U.S. President Donald Trump and the Fed Chair Jerome Powell had a tense exchange during a public tour of the Federal Reserve's $2.5 billion renovation project at its headquarters in Washington. The president jokingly said he would love for Powell to cut interest rates. Now, while Mr. Powell and his colleagues have the ability to do so, it may be highly unlikely they'll do so at the forthcoming Fed meeting on Wednesday. But let's get more from Luis Alvarado, Global Fixed Income Strategist at Wells Fargo Investment Institute. Luis, thank you very much indeed. Was there anything new yesterday? I mean, I know they bickered over the cost of the renovating the headquarters. Powell contradicted the president. It was rather interesting on his cost claims. But on interest rates, Mr. Trump, once again, like he has done innumerable times, saying he wants lower borrowing costs.
That is right. I mean, there was a little bit of back and forth. Of course, as we know, the president has been flooding the zone. Any individual that can contribute to persuading perhaps the Chair Powell or the rest of the members to do something in regards to interest rates. Of course, the president is looking for pretty much someone to help him out. But I would say the rest of the presidents throughout the month of July have been pretty clear in the sense that they're still on a wait and see mode. Obviously, there's a big threat coming ahead in regards to inflation that are produced precisely by this sort of tariffs. So the Fed wants to wait and see what happens. And I don't think they're going to succumb to any pressure from the president yet.
As for your strategy right now, we're calling it fixed income guidance and opportunities. You say high quality investment grade corporate bonds, mortgage bond securities and municipal bonds are decent ways to play fixed income right now.
Yeah, I would say investors have a really good opportunity still to capture yield, capture income. Interest rates remained at very attractive levels. And we know there was a lot of dry powder sitting on the sidelines, perhaps sitting in money market funds, in T-bills and CD savings accounts. So for those investors that have a longer term horizon, they have the capacity to go into higher quality right now, like you mentioned, investment grade corporates, mortgage-backed securities, and also municipal bonds for a more domestic portfolio. For global investors, of course, we like emerging market debt as an opportunity to kind of diversify and also displaying attractive yields.
Maybe we could have a look at the U.S. dollar. Does that factor into your calculations? I suppose if the U.S. dollar, if the global market thinks U.S. dollar is going to stay weak, that could deter purchases of U.S. bonds?
Yeah, we still see investors. I know there was a risk or potential risk, a tantrum from global investors when all the mayhem was happening after Liberation Day. But if you look at the actual data, you actually still see, foreign investors coming to the U.S. markets. U.S. credit markets, and I'm talking about U.S. Treasury debt and also corporates, they still have the capacity to attract a lot of foreign investors. And there's an acronym that is used, TINA. There is no other alternative, right? Global savings are in the trillions, and there's just not enough markets open or available to capture all of the amount of global investment and savings. The U.S. is a natural recipient of those flows, and we continue to see those flows coming in. To your point about the dollar, of course, we've seen the dollar dynamic over the past few months deteriorate. Our idea still remains intact when we discussed this a couple of months ago, is that the dollar will eventually continue to strengthen, and it's going to be backed up by those interest rate differentials kind of between Japan. You've seen some yields in Japan move higher in the long end. The ECB earlier last week, telling us that they're not going to cut and not cutting, and then giving us guidance on not cutting. And also, of course, the U.S., what they're going to do in regards to interest rates, which is still not very clear. I know the market consensus is for perhaps 4 or 5 cuts, talking about year-end 2026. We still think the market is way ahead of itself.
You've touched, you've touched on this, but there is going to be a stream of economic data next week, including GDP, as well as that Fed rate announcement.
That is correct. We got the labor markets as well on August 1st, so a week from today is going to be crucial. In between, kind of sandwiched in, is that Fed meeting. That's why we think the Fed is going to take some time to wait. August, it's Jackson Hole, so it's like a dead month. Congress is also on recess. September now is looking like it's going to be a confluence of factors coming together, both on the sort of political spectrum, also enough data for the Fed to kind of digest what have consumers been doing, some of the continued effects of tariffs. Although, next week, the key element for the fixed income, for the bond market, is the quarterly refunding announcement from the Treasury. That's Scott Bessent and team telling us now that the debt ceiling has increased, how much money are they planning to issue in the next following quarters? And then the dynamic is, is it going to be more T-bill oriented or more longer term debt in coupons?
We did hear talk a couple of months ago that there was a risk of indigestion in the U.S. Treasury bond market with massive issuance, that people could push back, partly because they were concerned that Trump's policies would make the deficit balloon. Has that eased that concern that the U.S. might find it hard to sell bonds at a reasonable interest rate?
It's tricky because we know that issuance is coming. There's still a lot of demand for U.S. debt. And the only thing that is moving is the cost of that, right? The cost of capital, it's moving higher. I know in the 30-year yield, we've seen, kind of rates move higher. It's been flirting with that sort of 5% give and take. And we do think that as more of that sort of fiscal stimulus start coming in and more money gets issued, that's going to create some pressure. The key here is that, Scott Bessent, the U.S. Treasury, has kind of hinted that he's going to issue more T-bills, and that will effectively try to keep some cap on longer term yields moving much, much higher than the administration would want to see. Obviously, they don't want to go ahead and see a 30-year yield around 5.25%. 550, that's definitely not in their intentions of what they want to do. So just focusing on the shorter end of the curve, issuing more T-bills, at least over the next couple of quarters before the Fed acts and does something. Now, if the Fed were to act and cut 2, 3, 4 times like the market is expecting, that is going to drive the entire curve perhaps a little bit lower. And that's going to keep the 30-year yield underneath that 5% sort of number, which is kind of key for the administration.
Just give us a final thought. It seems like this theme has gone away as well, though we heard, sovereign bonds, investors are turning away from them. They're worried about deficits all around the world. Has that eased, do you think? I know it's a very broad question.
I would say the concern is still there, and investors, especially the bond market, understands the risk of countries elevating or issuing the amount of debt that they have issued. But there is still so much capital, dry powder, and liquidity. You have a lot of private capital funds looking for opportunities. I would say issuers are coming into the market and they're finding it fulfilled. So there is still a lot of demand for investors. We talk about longer term longer term trajectory, I would say, is the fact that a lot of baby boomers are continuing to retire. They're looking to make shifts eventually as they sell their businesses, as they retire, change their allocations and reduce a little bit of exposure in alternatives or equities and move towards more of that fixed income, which is what they're going to be needing, right? More fixed income potential. And then you have pensions and sovereign funds in Europe, in the UK, in Japan. They're definitely looking for, asset and liability duration matching. So they do have demand for this sort of longer term debt. What we were discussing, Andy, is the cost of capital, right? How much more premium are you going to demand as an investor to be able to hold those bonds for a longer term?